welcome everybody. Happy to present our paper, Are Investors Sensitive to Impact? So as Julian mentioned, this is a collaboration with Julian, Falco Petzold and Stefan Zeisberg. I think all my co-authors are in the seminar. Very happy about that. So, but let's get started with our paper. Some technical issues. Now it works. So why are we doing this research? So I think in this crowd, I don't have to spend too much time on this. I mean, social responsibility of investors recently has been gaining provenance as kind of a response to market failure and a response to failure by governance to kind of to solve pressing challenges we have. For example, here you see that is colorful bricks of the Sustainable Development Goals. This has been kind of, sustainable finance has been promoted as a potential solution by some very prominent actors in economics, Benno Pithiol, Hart and Zigales lately. And at the same time, if we look to kind of the real world to investing, we see that sustainable investing is absolutely booming. So currently there is something like 31 trillion US dollars in assets that are classified as sustainable investments. So that's roughly 10% of global wealth, and I think soon like a third or something like of all professionally managed assets. So and numbers are strongly increasing. So sustainable investing is increasing, our global challenges are increasing. The question is, how can that fit together? How can sustainable investing make a contribution? And at the same time, we know behind this tremendous demand for sustainable investing, there has been quite some indications that the social preferences seem to be the primary driver for this huge demand. But I mean, our point is sustainable investing can only be effective in kind of curbing corporate externalities, in solving global problems, if investors' willingness to pay is sensitive to the scope of the externalities avoided, so the impact that investments have. And that leads me straight to our research question. So what we want to find out in our paper is, does it matter for investors' willingness to pay how sustainable investments are? So, or put it more figuratively, if we have sustainable investments, if we look at their impact, kind of, does it matter how much impact do they have? So I have trees here for kind of a very visual kind of placeholder for climate impact. So the amount of green investment saved, does it have an impact on the willingness to pay of investors for a given sustainable investment product? So if you look at the literature, what do we know so far on sustainable investing and the demand for it? So some very recent studies have shown that investors do actually value sustainability. So they put a positive value to it and adjust their investments accordingly. And more recently, even, there has been a nice study by Barber and other authors really showing that investors have a substantial willingness to pay for investments with impact. Now, if you look at a standard decision theory, I think it would predict that kind of the non-financial utilities investors gain from investing sustainably should in some way be scaling with the impact an investment has. So the idea here of this kind of pure altruism models is that individuals act pro-socially because they derive value from a social good. This could be, for example, if you look at climate change, kind of global CO2 concentrations. So if an investment helps to fight climate change, to reduce CO2 emissions, kind of its non-pecuniary value should in some way be scaling with the impact, the climate impact of an investment. But at the same time, we know from research on charitable giving mainly, that pro-social decisions are often strongly influenced by affect and emotions and can be surprisingly insensitive to the impact of kind of a donation. There's been a couple of interesting studies. And now if we combine these things, our question is, I mean, so does it matter how green investment is? So what about sustain? We know how things work maybe with donations, but we're in the domain of investing. So which is known to be a rather rational and calculating thing. So that's a question we're looking at. Does it matter how green a green investment is? And we approach this question with a pre-registered framed field experiment. So our base design is we measure investors' willingness to pay for an investment with impact, for a sustainable investing, compared to a financially equivalent investment with no sustainability credence or with no impact. And what we do, we vary the amount of the impact the sustainable investment has between subjects. So if you frame it differently, so our independent variable is impact of an investment. A dependent variable is the willingness to pay for the impactful investment option. And we measure impact in tons of CO2 emissions saved with the investment, just because we think CO2 emissions is a clearly quantifiable and kind of universally accepted unit of impact. Let me say a few words on our sample. So we work with real investors. First of all, we work with a panel of more than 500 experienced Dutch investors. We'll say more about these. And also, we work with a unique panel of over 100 ultra-high net worth dedicated impact investors. And I think important, we work with kind of really consequential decisions. So based on decisions of participants, we kind of select randomly 10 of our participants and make, based on the decision, a real investment of €1,000, which after investment period, they will receive the full value of the investment. So kind of it is consequential in terms of finances, but we also want to make sure our experiment is consequential in terms of the impact that that investment has. So we based on the decisions investors make in the experiment, we invest in verified carbon offset projects to make sure that all decisions are also consequential when it comes to impact. Let me spend a few words on what may be further reasons, I mean, to study sustainability preferences of investors, so kind of very connects to a broader existing literature. First of all, in examining kind of the drivers behind the demand for sustainability has been literature has been growing there strongly over the last couple of years. And especially also, there has been quite some theoretical work that predict that sustainability preference of investors will affect asset prices and increasingly also kind of corporate investment decisions on sustainability. So the question is, if there's more and more sustainable investors, will that change asset prices? Will that cause companies to become more sustainable? And we hope to make a contribution also there, but kind of by establishing how impact affects investors' preferences and demand. So first, let's go a bit deeper into the experimental design we use. So we use a rather simple setup. It's a set online experiment with real investors. It takes something like 20 minutes. First, investors receive detailed instructions, and then they are separated in two different information treatments. So we have a high impact treatment and low impact treatment. As explained, in their investment decisions, investors have to make decisions between two funds, a non-sustainable fund and a sustainable fund. And between the two treatments, we vary how much impact the sustainable fund has. So in the high impact treatment, investing €1,000 in the sustainable fund saves 5 tons of CO2. And in the low impact treatment, it's only 0.5 tons of CO2. So in terms of impact, we have a difference of a factor 10, so quite significant. After investors receive information, and we'll show you a bit more how that looks, they make a series of investment decisions. 7 investment decisions. Here we apply a bisection method combined with Becker-de Groot mechanisms to make sure that all decisions they make are incentive compatible. And then as a last step, we collect a series of control variable manipulation checks in order to have more material to evaluate our findings from the main experiment. So let me show you the treatment, information treatment. So investors, here you can see we have Fund A and Fund B. Fund A, in this case, is the sustainable investment. you see it, the low impact treatment, so the fund saves, investing in this fund saves 0.5 tons of CO2. In the high impact treatment, it saves 5 tons of CO2. Now, we have a couple of concerns that we want to alleviate in our design. First of all, not everybody may be familiar with what a ton of CO2 is. So we make sure to translate CO2 emissions to more accessible, intuitively accessible units. So number of trees that kind of are equivalent to plants to save this amount of emissions, kilometers of air travel, or the average emissions caused by a EU citizen. Secondly, we want to make sure that when investors make the investment decisions, the impact is salient. So first of all, investors always see the information you see here and they make their decisions. And we also, specifically before they start with decision, we have a small quiz where they really have to repeat all the information. And in a manipulation check after the investment decision, we see that 95% of participants can really accurately recall the impact information. So I think we can conclude that impact information is salient when the investors make their decisions. And another potential concern are experimental demand effects. So especially if you work with pro-social goods, that may be a problem, that if you have like an experimenter sitting in the same room, you want to please the experimenter. First of all, we work with a completely anonymous online setup, which has been shown that the demand effects are much lower. And what we do is we frame sustainable investing in an ambiguous way. So we provide information on sustainable investing, but we don't make it clear that we think that's a good thing if you want to help the planet, or if that's maybe even a bad thing if you want to support fighting CO2 emissions. So we really leave it open to investors to decide whether they think sustainable investing is actually beneficial. So let me spend a few more words on our main sample. So we source investors among the members of the VEB, which is a Dutch interest group of retail investors. They have something like 40,000 members. And what the VEB does, they do, for example, collective lawsuits for small retail investors. They provide independent information on different companies and so on. And the characteristics of members of VEB is they're not super wealthy, but they are wealthy to some extent, which you also can see from the demographic information here. And they're certainly experienced and interested investors. So what we also know from VEB, investors join this group if they're really into investing, they care about their investments. So we can, I think, conclude that investors in the sample should be familiar with making investment decisions. And also importantly, the VEB does not have any specific focus on sustainability. So these are kind of average Dutch investors. And if you look at the demographic, you can see also they're rather old. So on an average 62 years old and rather male. We only have 12% of female. So kind of you could argue this is kind of a set of older traditional private retail investors. But now, without much further ado, let's come to our main results. So do investors value how much impact investments have? So first of all, we see investors do have a substantial willingness to pay for investments with impact. So on average, for 1,000 euro investments, investors are, in terms of fee, I forgot to mention that, we measure the willingness to pay in terms of additional fees investors are willing to pay. So for a sustainable investment with some impact, investors are on average willing to pay something like 40 euro. That brings me to our main question. Second point, does this depend on the level of impact? And we find no, it does not. So the amount of impact an investment has does not have a significant effect on investors' willingness to pay for this investment. So we literally find more or less the same values for two different investments between subjects where we have a factor of 10 difference in the impact of these investments. And if we now see, if we kind of look at how much are investors' willingness to pay per unit of impact, we see that kind of this very insensitive valuation leads to the clearly inconsistent valuation of a unit of impact. If you look at the graph to the right, here you see the median willingness to pay per ton of CO2. And it's obviously it's much higher in the low impact treatment than in the high impact treatment. So kind of connecting to this factor 10 difference, we also see a factor 10 difference in relative willingness to pay. So I think let's keep that in mind. That's our main finding. We see investors are not per se sensitivity to the impact of investments, although they are willing to pay substantial amounts of fees for sustainable investments. Now, let me come to first brief in robustness check. So we just want to be sure that what we see, this insensitivity, is not a pure artifact of the specific experimental design we use. So we, as a robustness check, we take a domain where we know investors are sensitive. So we take past return information. There has been quite some studies showing that investors are by large rather sensitive to past return information on the past return of funds. So we slightly adjust our experimental design, but most things are equal, are the same. So we have now two treatments again. So a low return treatment and a high return treatment. And you can see also, again, we have two funds. So we have kind of a low fund, which has 5% of past return. And fund A here in this example has slightly higher, so 0.5% higher past return. And in the higher treatment, it has 5% higher return. So the return advantage, again, we have a difference of a factor of 10. And if you look at the results, we can see with the exact same setup, just transferring to the domain of past return, we can measure exactly the sensitivity we would expect. So investors are willing to pay a fee of 5% for €1,000, €5 for €1,000 investment, and for 0.5% past return advantage. And for a 5% past return advantage, they're willing to pay 50. So that's exactly what you would more or less expect for €1,000 investment. So I think with that we can say that this insensitivity we see, which is quite clearly, you can see quite clearly, is most probably not driven by our experimental design.
How do you change the CO2 impact of the fund? Is it something you do sort of artificially, or is it something that the fund does, or is it something that you offset, or how is it working?
We do offsetting. So what we don't say this explicitly. What we do is kind of if people are selecting, we kind of invest in a bundle of a traditional S&P ETF and an investment into a carbon offsetting project.
I see. Thanks.
So we try to make it as clean as possible. So maybe it's best if I move on with kind of so where we stand is we know that investors are not sensitive to impact in the way we had our experiment. So what are potential explanations for that? So we went into the literature in psychology, financial economics, general economics to figure out what could be reasons. So the first reason we came up is that investors would be sensitive to impact, but they're just not able to evaluate the impact of investment. So that means investors may kind of be able to see what a ton of CO2 is in numbers of trees and have a good understanding of that, but it's just could be hard for them to say whether saving 30 trees is good for $1,000 investment or saving 3 trees. So kind of evaluating impact in an investment context. So here we would assume, yes, investors are rational, they're kind of consequential, so they care about the impact, which will correspond to these traditional pure altruism models. But the cause for insensitivity is just missing expertise and knowledge on impact in an investment context. Then a second explanation is that investors may want to make a certain contributions, but beyond which they do not really gain more utility. So this would more correspond to the view of sustainable investments as rational, but more this deontological, kind of in the line of the satisfying or aspiration models as been proposed quite a while ago, where people, they don't maximize a certain level, a certain attribute, but they just want to pick something that fulfills a certain level that they think that's enough as their own contribution. So a cause for insensitivity could simply be that investors consider both our treatments as green enough to make a fair contribution to climate change. So, and a third explanation is that investors' demand may be driven by effective utility that investors gain from the act of investing sustainably. So this is more connected to models of decision models of warm glow, impure altruism, that where individuals are not driven by rational thinking about the real world outcomes, but more kind of from the emotion effective responses, selecting a certain option causes internally. And here the cause for insensitivity could be that the effective utility just does not depend on the real world impact. It just depends on doing something that feels good, selecting the green option, ticking the box to be a good person. And we will go through this briefly through this three potential explanation of the observed insensitivity. So let's start with the first cause that we propose, so missing expertise and knowledge. So here you can see we after the experiment we ask investors opinion on different points concerning the two options they have. We ask them about their risk expectation, return expectation, and also their impact judgment. So whether they feel the impact really makes a valuable contribution to fighting climate change. And what you can see is firstly on average, we don't really see a strong opinion on risk and return. We don't really see between the treatments any difference in risk expectation. There's a slight difference in return, but also not significant. So we really wanted to explore this expertise direction. So we recruited a sample of dedicated impact investors who arguably should have expertise in evaluating the impact. So we collected, I think, first-time unique sample of impact investors over different channels. So we used the CSP network of impact investors from our own training programs on impact investing. We worked together with two impact investor networks, and we with different private banks and wealth advisors, we collected investors from their impact investing customer segments. So overall, we're able to collect a sample of over 100. The number here is not accurate. It's 119 impact investors. If you look at the characteristics, demographics, compared to the private investor sample, these are younger, more female, and certainly they have a much higher income and rather high wealth level. So we have something like 1 to 10 million. But I have to add, many of them didn't give us any information on their wealth. And from the networks we use to source, we know that if you look at the family context, their wealth may be substantially higher than what we see here. So we can say these are dedicated impact investors that have should have the experience and the means to really care about the impact of their investments. So the question now, are these impact investments sensitive to the level of impact? So in a nutshell, no. Also here we don't see sensitivity. We see slightly higher on the right. You have the numbers for the impact investors. Also here again, low and high impact treatment. So we see slightly on total slightly higher willingness to pay for the impact investors. It's not really significant. And again, we see almost no difference in the willingness to pay between the low impact and the high impact treatment. So we can conclude even dedicated impact investors who arguably should have the experience to judge impact are not sensitive to the level of impact. So in our view, we can mostly rule out that expertise is the main cause. Missing expertise and missing availability is the main cause for the insensitivity we observe. Then let's move on. So the second explanation was that the satisfying aspiration level group of explanation. So could just be that all our treatment groups are just green enough. And here we did exactly what was Anne Beck proposed before. We repeated our experiment, but this time investors had both treatment could see both treatments at the same time. And we asked them consequently to evaluate both funds, Fund B and Fund C, in terms of their willingness to pay. So moving from a single evaluation setup, we move here to a joint evaluation setup where investors have the full range of treatments available. So what do we see? I mean, compared to our main experiment. Firstly, we see that if we move from a single evaluation to a joint evaluation, sensitivity increases. So investors in this setup are, at least to some degrees, they're sensitive to level impact. So we have something like 20 willingness to pay euros for the low impact treatment and above 30 for the high impact treatment. I mean, first of all, I have to add, in no way this is still not proportional to the the factor of difference in impact, the willingness to pay. But at least we see some level of sensitivity. But and we also showed the willingness to pay seems, the range of options we provide to investors really seem to impact their willingness to pay. So for the lower fund, we have a significant reduction in willingness to pay. So, but this is not really consistent with a satisfying or aspiration explanation where one could argue that, yes, the insensitivity we see here in our main experiment is just because investors feel that 0.5 tons of CO2, that's enough impact to do their share or reach their level of aspiration. Because here we see, if they see, oh, there's other option, there's higher option, it really reduces their willingness to pay for low impact options. So then we come to the third possible explanation. We explore kind of this effective direction. So is investors' willingness to pay for sustainability driven by emotional effective valuation that does not really necessarily depend on the level of impact? So after the evaluation task, we're back now in the main experiment. We also ask investors about the feeling. So how good does it feel to choose the sustainable option? So we find, again, here we find on average, there's a significant positive emotional reaction that investors report, both for private and impact investors. But we see at the same time between the high impact and low impact treatment, we see no significant difference in how positive investors feel. So to sum that, investing in green funds seems to feel good, but irrespective of the impact. So a warm glow valuation is kind of compatible to what we observe here. So with positive effective reactions that are not dependent on the impact. But this opens up the question, so what about the joint evaluation findings? So the sensitivity in the treatment we just saw some slides before. So how is that compatible with just positive feeling that doesn't really depend on the impact? So what we did as a next step is, besides the treatment you see here, this joint evaluation treatment where we have the same two funds as in our main experiment, so 0.5 tons and 5 tons of impact, we also had a low impact range treatment where we do the same thing, but instead of 0.5 and 5, we provide investors with 0.05 tons of CO2 and 0.5. So we don't have high and low, we have very low and low impact treatment or impact funds. And what we see here, yes, increasing comparability increases sensitivity. We saw that before, but the range of options seem to have a very strong effect on this sensitivity. So investors seem to evaluate the impact strongly relative to the other salient investment options. So Here on the left, you see the lower impact range where we compare, the investors can choose between the very low and the low impact fund. On the right, you see the higher impact range treatment where investors can decide between the low impact and the high impact treatment. And we see an almost identical setup. In both setups, we find a significant difference between the lower and the higher, also here, fund, but we don't see any qualitatively difference between the very low and the low, between these two treatments, and the low and the high. So it seems that investors value sustainability strongly in comparison to other kind of the range of options they have available. So following an interesting paper we found, we introduce a measure of relative warm glow. So kind of extending these warm glow notions, just do a good thing, and the act provides you with warm glow utility. We extend it and saying warm glow, the warm glow investors experience depends on if they select an option where the impact of this option stands compared to other available options. So it's a simple formula saying that the warm glow investors derive is a function of the impact of all available options, and it's just kind of a percentage number, proportional to percentage number, where an investment stands on the range of all available options. So if we take now all the results from the joint availability treatment, if we move back here, what we found here, and put this into a global least fixed effect regression, we first of all see if you just take the impact as a measure, the impact has a small but significant, the actual impact in tons of CO2 has a small but significant impact on investors' willingness to pay. So that's, I guess, what you can see here. I mean, although we have, again, a factor of 10 here between, we have a small difference in investors' willingness to pay. But if we then introduce our measure of relative warm glow, we first of all see this is really able to explain investors' willingness to pay quite well. And at the same time, the predictive power of the actual impact in tons of CO2 completely vanishes. So from that, we can conclude, first, I mean, a relative approach to warm glow may be quite well able to explain how investors evaluate sustainable investment. So if we kind of sum up all our findings so far, so first of all, we see investors do have a substantial willingness to pay for impact investments, and that confirms what other experimental and empirical studies have shown. But I think what we contribute to this literature is showing that the level of impact does not have, per se, a significant effect on investors' willingness to pay. And as a third point, our findings are compatible with an effective or relative warm glow explanation of investors' valuation of sustainability. So we discussed before, there's different views of sustainable investors. One view is this consequentialist, and investors really optimize their impact. Another is more on this deontology, kind of to do the right thing, just investing in doing a certain share, choosing a green option, and then that's enough. What we find is more compatible could sum up maybe as a lazy consequentialist. So if investors just if a retail investor goes to the bank and receives the option to invest in a sustainable product next to many other non-sustainable products, our result would predict that he would just gain a lot of utility from choosing the sustainable option if he's pro-socially minded. Nevertheless, kind of unrelated to the actual impact of that investment. But in a setting where a wealth manager may offer him like a range of investment options, then suddenly it would change in a relative view, and the willingness to pay would become, and demand would become sensitive to the impact but again, only in the range of available options. So summing up, our findings indicate that it does not matter how green an investment is, but as long as an investment feels green. And also, how green it feels seems to depend strongly on the range of options investors have available. Now, what are the implications of these findings? So, first of all, if investors' willingness to pay is not proportional to the impact of investments, this huge demand for sustainable investing we saw in the beginning, so this growing demand for sustainability may not necessarily translate into real-world outcomes. So banks and asset managers may actually have limited incentive to design products that focus on delivering real impact, and there may actually be incentives to do greenwashing. So designing sustainable products not with the view with focus on impact, but with a focus on eliciting actually exactly this positive warm glow feelings or effective responses that investors gain from selecting a product. So designing products that look green instead of causing impact. And maybe as a remedy, what we also can conclude from our finding is that comparison can increase sensitivity. So if what I just mentioned before, if investors have a range of sustainable investment options available or information on a range of investment options, this may induce sensitivity and may help to connect investors' demand with real-world change. And I think one recent development has been that there is an increasing amount of sustainability and impact rating for funds. On Morningstar, there are now these globe ratings. I think that's a very prominent example where investors now can compare the impact of one sustainable investing product to a range of other products. And as one interesting paper by Hausman and Sussman, so this affects fund flows if investors get this information. But I would say our results also highlight that the choice of often arbitrary benchmark to assess the sustainability of funds and these ratings use will strongly affect investors' decisions. So if we come back to these Morningstar examples, they give something from 0 to 5 globes, and they do this rating strictly as a peer comparison. So the Morningstar takes a certain fund category based on financial aspects of funds, and then just does kind of a percentile view on where investments stand in terms of sustainability, carbon footprint, and so on. But this does not really answer the question, is a sustainable investing that has 5 globes sustainable enough to reach, for example, the Paris 2 degrees world where we can reduce carbon emissions enough to be on track. If you look at what's currently going on and regulators are increasingly stepping in they want to use sustainable investing as a tool to shift, to reach our global targets, to reach Paris Agreement, to reach the SDGs. One implication we could provide to them is saying it is worthwhile promoting sustainability ratings, and I think that happens with, for example, also this EU eco-label discussion. But one important part a regulator could play is ensuring that these ratings are really aligned with societal goals. Because what we can see from our research is that the way where you put the endpoints of any given rating will affect how investors make decisions and will affect how they evaluate sustainable investment options. Good, thanks a lot. That was my talk. So now I'm looking forward to have an interesting discussion.
After more than 2 decades in the industry, I'm more than ever convinced that women are much more prone to sustainability and impact investing. So I think that from this experience, that the bias you've had in the retail investors sample you had with just how much, 12% women? this very important group simply might be underrepresented. Also, and now, sorry for that, I have a little advantage, because we as a bank are also asking the question of sustainability preferences. And I have a treasure, so to speak, of 170,000 answers to that. Is that this preference is also varying substantially across age. And interestingly, the older you get, typically the preference is typically lower. So this also might be a bias to this.
Yeah, yeah. I mean, these are certainly interesting points. So, I mean, we were really surprised to see that even in this very male-dominated and older sample, we have a substantial willingness to pay. And I think I'm really happy that we have this impact investor sample as a contrast that really looks different, younger and more female. But then I think it's interesting to see that in terms of impact sensitivity, we see more or less the same behavior. We see some small difference in the level of willingness to pay. But for me, this points out that you may have a strong kind of variation on preferences, but the way investors evaluate and decide, there may be some common patterns. So,
okay.
Maybe quickly to add to that, I'm Stefan, co-author of this paper. Hello to everybody. If I remember correctly, and Florian, please correct me if I'm incorrect, we even find this in some pre-tests we did with students, where the gender balance was much more to the direction of 50-50. And I mean, age-wise, we're going very much into your suggested direction. But the results seem to be similar. So among all different groups we tested, it's looking very similar.
Yeah.
Okay.
Yeah. I mean, certainly
Thanks.
the student sample even has on aggregate a higher willingness to pay. I mean, and we also see kind of, if you check on how important they think climate change is and how altruistic they are kind of more eager to solve global challenges. But it seems to affect the level of willingness to pay, but doesn't seem to affect the sensitivity to impact.
Okay.
Yeah, I think that's really the important point. They are willing to pay more, but they do not differentiate between like really green and just slightly green investments. I think that's the main point here.
Sorry if I just ask a follow-up question. Could it be simply a matter of information, of cost of information? Because investing sustainably, okay, you reduce it to carbon emissions, which makes life much more simple, of course. But when it comes to sustainability investments, of course, you have E, S, and G, which typically spreads across, I don't know how many, depending upon the research provider, 30, 50, 80 indicators, which makes it rather messy. Isn't it just maybe rational then to delegate this processing of information to somebody else, and then what you just said before, be, so to speak, satisfied with somebody's taking care of it, and that's just it? Thanks very much.
Yeah, that's an interesting perspective. So what you say is investors may want to have impact, but they're just not, they just trust what you offer them as a sustainable investment. Because
when we did some market research, interestingly with high net worth female investors, this was one of the most often mentioned topics. When we showed the research process and the criteria and everything else, so lots of data and information, these women that were very, let's say, interested in the topic itself, simply said, it looks great, it sounds sensible, but for that reason, I simply trust you. So they didn't want to dive deeper, and so it's just like a ticking a box. Well, it sounds sensible to me, and therefore I accept it, and that's it. So it's just the first step into it that is sufficient enough. So what your thesis you mentioned. So I just want to pinpoint that.
Yeah, interesting. That is certainly an aspect we could explore further.
One thing that suddenly popped into my mind is, have you compared, or is there any research not on sustainable investments, but on consumer products? So let's just take bananas. Is there also a difference in willingness to pay, depending upon, or not a difference in the, let's say, sustainability, grade of sustainability? So fair trade is fair trade more highly valued than just organic? I mean, there are 80. I mean, overall, 80 eco labels out there. Have you tried to compare to consumer goods? Would we expect a different behavior there?
I have tried to do that. Yeah, I mean that has been kind of an interesting avenue to go down. There hasn't been much there. The main work has been done is mainly on charitable giving. But what we see there is also interesting that one finding is that read kind of consumers, especially for food products, they often overestimate kind of how sustainable products are. So especially for kind of on the higher range. So again, there we also see, so there was an interesting study for kind of for meat products, for example, looking at how what people think how animals are actually held and what the conditions are, and people grossly overestimate the conditions for positively labeled products, which for me also shows, I mean, what you have been saying in this direction, that there seems to be quite a lot of trust that your retail store offers you products that are good and are good enough, and that with just choosing like certain labels, you have the impact you would like to have. But would be interesting to look at how strong is the interest really to dig deeper. So if you look at our results, I mean, even if we have kind of very low impact funds, people report quite a positive level of feeling. So, I mean, investors seem to be happy with what they get, irrespective of maybe the impact. So do investors really have an incentive to dig deeper and to question and investigate what is actually in these sustainable investing projects, and what do they actually cause in the real world? So certainly some investor segments will do, but on average, that's maybe also a question to explore.
Maybe just one thing. I mean, I guess you're sure aware of that, but this research is really highly relevant right now in the EU context. First of all, you already mentioned the eco label currently that is currently planned, and you guess you're aware that the third version of the eco label for financial products is the draft is out right now. So the question will be, will people rush into that just because there's also the eco label on that, or will it be just sufficient to get the already available sustainability products out there? And secondly, due to also the upcoming EU regulation, there will be a hell of a sustainability reporting coming, and it will be quite interesting to see whether, and this is my thesis, a hypothesis, that I guess at least retail investors typically won't care about that. If we provide tons of information about what is the exact amount of carbon water we use on, and how many, I mean, the EU is dreaming about 30 indicators. Could that mean that this is an informational overkill?
Potentially, yes. I think it will be really interesting to see what will happen on the EU level. I think there will be a lot more kind of requirements to report. But the question is whether investors can actually will and can take this information to optimize the impact of what they're having, or want to do that.